Hello, my name is Harry Starn, and I serve as the Director for the MBA in Financial Planning program here at California Lutheran. In this presentation, I will address credit scores and talk about how to build good credit. Before we move into those two areas, let's take a couple minutes to talk about a few fundamental concepts. One of the core concepts that flows through all of corporate and investment finance is the idea of risk versus return. Simply stated, in order to accept a higher level of perceived risk, you're entitled to a higher level of expected return. So a lender is going to expect a higher interest rate if they're borrowing to someone with lower credit quality. Lenders try to assess that credit quality or that credit worthiness, and they do that by looking at the 3 C's. Lenders refer to the 3 C's as capacity, collateral, and character. Capacity refers to the financial ability to repay the loan based on present and future earning power. Collateral is the idea, is there any real asset or financial asset directly backing the loan? For example, if you have a mortgage, the home is a real asset backing that loan. Character refers to the borrower's commitment to repaying the loan and exhibiting financial responsibility. We'll take a look at how a lender will assess that in just a moment. On this mind map, I show 8 different categories or factors that affect your access to credit. So the lender will take a look at first your employment history. Where are you working now? How long have you been there? Do they see upward progression in your future? So consistency in employment is important. Now that doesn't mean that if you were to leave a job for a higher paying job for a better opportunity, that would be a negative factor in assessing your credit rating. But it would if someone is bouncing from job to job and there's not that progression. Why? Because that's an indicator of stability and also income potential. The second one is income. What income do you have to support those interests or those loan payments? And is that income progressing? Job raises, upward mobility. A third category, a third factor, is your residence history. Do you own a home? Are you renting? And for both of those, how long have you been at that location? The longer your history is in renting or also owning the home, that's stability, that demonstrates the ability to keep making those payments, to handle those home residence costs. A fourth category is financial situation. What assets and liabilities do you have? So the lender will take a look at your statement of net worth. And some of you who study corporate finance would think of that as your balance sheet. What assets do you have? What bank accounts do you have open? Do you have any other assets that could be used to repay the loan? Likewise, what liabilities do you have? Do you have other credit cards? Do you have student loans? Do you have auto payments, home mortgages? All these factors tell the lender a lot about your financial situation, your ability to service the debt. Debt repayment history is quite important, and that refers to your ability, your demonstrated ability to service the loans, to make timely payments, at least making minimum payments when they're due. Litigation. Do you have any lawsuits against you? Are there negative issues like bankruptcy, liens, wage garnishments? Because all of those would impact the ability to repay. Personal characteristics, and that certainly comes back again. How committed are you to repaying the loan? And credit applications. Is there evidence that you're going out trying to take out a number of credit cards at one time? What are the types of consumer debt? Well, we can take a look at two different categories, installment debt and revolving credit. Installment debt is debt with regularly scheduled payments, which are based on the set terms of the loan. For example, a mortgage might say something like over the next 30 years, there'll be monthly payments at a rate of 5.5%. Revolving credit, on the other hand, is like a credit card. It has a pre-established credit limit that can be borrowed against over time as long as you're in good standing. So perhaps the credit card gives you a $10,000 revolving credit line, and you can keep borrowing up to $10,000 at a time as long as you continue to keep making those minimum payments, paying it down. So this is a standing credit. Here are some sources of credit: installment loans, the home mortgage, a home equity loan, auto loans, student and education loans, personal loans that have a terms. Characteristics: there's a contract or a loan agreement. The repayment terms are stated, including the number of payments, the amount of the payment, the due date, the stated rate of interest. Revolving credit, as we just mentioned, is open-ended. It includes credit cards, store charge cards, overdraft protection, home equity line credits, and revolving check credits at banks. And so what are some of those characteristics? Well, it's a line of credit with a pre-approved credit limit. No finance charge if repaid by the due date. Otherwise, there's typically a high finance charge with minimum payments due. One other fundamental before we move on is the cost of credit. Truth in Lending Act requires lenders to provide an annual percentage rate, an APR. That is the cost of credit, the finance charge, stated as an annual percentage rate. It's useful in comparing different cards, but make sure you read the fine print, because two cards that are charging you 15% APR are not necessarily the same. That's because there can be used different methods to determine the finance charge. There may be other fees that are not shown in the annual percentage rate, and there may be penalties if you're delinquent in making your payment. But the APR is a good starting point. The monthly percentage rate is 1/12 of the annual percentage rate. So if you're taking out a card with an 18% APR, the monthly percentage rate is 1.5%. Okay, so what's the credit score? What is this all about? Scores in the FICO range from 300, and that's low, a bad credit rating, to 850, which would be like a 100%, a scale on a 100%, 850. It's very tough to get there. But when you're in those mid 700s to the 800s, that's a very high score. Now, remember, this is just a snapshot of your credit risk at a point in time. It's based on 35% of the score on the payment history, 30% on the amount of debt owed, as you can see, 15% on the length of your credit history, 10% gets into those new credit applications, and 10% the types of credit used. Have you demonstrated the ability to manage installment and consumer or revolving debt? So you see how these items all flow back to that original mind map as we walk through it. But also I pulled together this table kind of to show you how those 5 categories connect back to the 3 C's. So payment history, your ability to show that you can manage different types of debt, says a lot about your character. The amount owed certainly impacts the capacity. The length of your credit history, back to character. Applying for new credit, well, that says something about both categories there. And types of credit used, managed, your character. So again, we get into 2 of the 3 C's are impacted in your FICO score. The one item that's not shown here is the collateral, and that's sort of a different issue. That's when you're applying for different types of debt. There are 3 nationwide consumer reporting agencies. There's other, but these are the 3 largest: Equifax, Experian, TransUnion. The Fair Credit Reporting Act requires each of these companies to provide you with 1 free copy of your report once a year. You can order that at annualcreditreport.com. So what's this report look like? Well, first of all, the report was created by Fair Isaac Corporation. That's where the FICO comes from. And it includes 4 sections. The first section is personal information about you. The second section is your credit accounts. When were they opened? What's the credit limits? What's the balance? The payment history. Section 3 looks at inquiries by lenders, both voluntary, so you're applying for some credit, you're looking to buy a new car and take out a loan from the auto company, so there'd be a voluntary inquiry, and also involuntary inquiries, and this might be where liens or that sort of issues. Section 4, negative items, delinquency payments, bankruptcies, wage garnishments, and liens. The image on this slide is, you can see it's part of the report from Equifax. It happens to be the FICO score summary. And you can see the different categories rated as good, very good, probably fair, and, well, it would say good, great, bad. You can see that little thermometer on the left there. Here's another image. This is moving at credit at a glance. And you can see some of the information there. And if you get access to one of these, you can go online and take a look at the items. So now that you know a little bit about what the FICO score is about, what impacts that FICO score, let's look at the process of establishing good credit. As an undergraduate here at the university, this may be the first time you're looking at starting to build credit. So what are the first steps? Well, you want to open a checking and savings account. Open a debit account. Open a credit card account. We'll talk about this more in a moment. And if you are living off campus, open utility accounts. You're starting to create some history there. The idea is you're going to start to show that you can manage credit. Let's look at that third one, opening a credit card. 2009, the Credit Card Reform Act banned credit card companies from offering just credit cards to those under age 21. And this sort of was designed to correct an abuse where just everyone was getting a lot of credit card applications. Now, if you're under 21, you can get a credit card if you can prove adequate income or if you have an adult cosigner. That's typically your parent, right? And so even if you can do this and get a card with a low credit limit, you start to establish your history, your ability to do this. You start to show your character of making timely repayments. Another way of doing that, you could piggyback on one of your parents' cards. And FICO accepts this as a way for someone with no credit to start to build some credit. And that's where your parent would put you on the card as an authorized user. So that's a third way to start building some history in dealing with consumer debt. Building your credit history. How to build that good credit history. First of all, you want to control your use of debt. Create a good repayment history. Make at least the minimum payment on time every month. Demonstrate the ability to manage different types of credit. And maybe this is as you move out of school and buy a home or whatever, you're dealing with installment debt, getting a car or repaying on your student loans, having some revolving credit accounts. That can be a credit card, a store credit card. And the other thing you can do is if you're checking your credit rating once a year, make sure that everything is accurately reporting. So there wasn't any incorrect reporting to the credit agencies. While we can't do anything to correct, you know, proper reporting to the agencies, we can certainly get in there and say this was incorrect, and I call them up and have it corrected. Hint: a good way to start building a credit history is to make smaller purchases and timely payments. It's not the amount of the purchase that matters, but it's showing your ability to manage the debt. So if you can get that first credit card, even with a small limit, have simply a small balance on there, repay that every month. Selecting the card. Now, all cards aren't created equal. Look for a card that offers low annual percentage rates, no or very low annual fees, with a reasonable credit limit. Now, hint or something to note: when you're looking at credit cards that promote perks such as travel miles, money back annually, or a zero interest card for a small period of time or a certain period of time, all those perks get paid for with higher interest charges once they kick in, or once you fail to make that payment, full payment, by the end of the period. So consider that, especially in those first cards. Maybe stay away from the cards with the perks. Go for those plain vanilla cards, low annual percentage rates, no annual fees, reasonable credit limits for you. What's the implication of low credit ratings when you fail to make your minimum payment by the due date? When you start to be delinquent in payments? Well, some of the impacts are higher cost of consumer debt to you. You may have difficulty in acquiring loans. You may need to put down security deposits to get a utility. Or if you're looking for a rental or a down payment on a home, you may have to put down larger down payments because of your lower credit rating. Note also that negative events like a bankruptcy, a lien, can impact future access to credit, and it can even impact some job prospects. For example, bankruptcies can be a barrier to entry into some of the financial services career paths. What can you do to repair bad credit? Well, you have to start rebuilding the credit. You have to show that you're committed to digging yourself out, start making your credit payments on time, set up payment reminders so that you get that done, commit and show that you're paying down your debt, and if you can, as mentioned, if there's incorrect data in your credit report, try to get that repaired. What aren't you going to do? Don't panic and start closing or opening new credit cards trying to manipulate the score. That will probably work against you. And you have to realize that it simply takes some time to fix your low score. You're going to start applying the same techniques you would have used in building good credit. So wherever you are, you start applying those now. You start demonstrating it. And remember, a credit score is just a score, a rating at a point in time. That will change. It can go up or down. You know now what to do to kind of repair your credit rating. Okay. If we were in a classroom, we'd sit around talking about your learning takeaways at this point. But again, I hope you found this information useful as you move forward throughout your time here at CLU and as you move into the workplace. Best of luck to everybody.